Hi, it is Shivkumar from CSC department. Today from Principles of Management, we are going to see the topic type of business organizations. Let's get into the topic. Types of business organization. Based on the five criteria, the business organization, types of business organization varies. Normally, the formation, the members, the capital contribution, the liabilities, control and management, and the continuity. Based on these six criteria, the business organization can be differentiated into four types: sole proprietorships, partnership, cooperative society, and companies. And based on that, the sole proprietorship, partnership, companies, cooperatives have advantages as well as disadvantages. These advantages and disadvantages can be shown in the tabular column. Mainly, most of the advantages given to only for the sole proprietorships because he is the only person who owns the organization. So he no need to worry about any other things. And the main advantages of sole proprietorship is easy and inexpensive, low cost startup, least regulation, decision control, minimal capital and profit ownership. Similarly, his disadvantages unlimited liabilities, high tax rates, limited continuity, rising capitals. And similarly, for partnership, company, and cooperative is shown in the tabular column. In the appropriate ownership forms, that is normally the factors and most advantages and least advantages. Based on this, we have divided into certain topics, that is availability of capital. For companies, it is most advantages, and for sole proprietorship, it is least. Cost of formation, for sole proprietorship, it is advantages, and for company, it is least. Ease of formation, it is easy for the sole, and for the company, it is very least. Transfer of ownership, company except the private company, and in partnership, it is advantages. Managerial skills, company, sole is least advantages. Regulations, sole. Flexibility, sole proprietorship. Continuity, company, and liability. The joint stock company. The joint stock company, or simply a company, is a voluntary association of persons generally formed for undertaking some big business activities. It is established by law and can be dissolved by law. The characteristics of joint stock companies are formation, separation, separate legal entity, common seal, perceptual existence, limited liabilities of members, transferability of shares, membership, and democratic management. Types of joint stock companies. Private company. Under the Company Act 1957, by private company we mean a company which has the following features. It cannot have more than 50 members. Employees of the companies are not included in this. It cannot invite the public to purchase its share through open invitations. It restricts the right of members to sell or transfer their shares. It must have minimum paid up share capital of 1 lakh rupees. Similarly, the public company, for starting a business on a large scale, one need a huge capital which even 50 members of private company cannot provide. In such a situation, a public company is suitable. A public company must have the following features. It can invite the public to subscribe to its share and by open invitation. A minimum of 7 members is required to establish a public company and no limit for maximum numbers. There is no restrictions on transfer of shares. The public company must have minimum paid capital of 5 lakhs. And the government company, any company in which at least 51% of paid up capital is held by government, is known as the government company. Example: Bell, statutory company, a company created by a special act of parliament or state legislature is termed as a statutory company. Example: LIC, chartered company, a company created under a special charter granted by a king or queen of England. Example: East India Company. Foreign company, a company which is incorporated in a country outside India and having a business operation in India is known as foreign company. Example: Citibank, Honda, etc. Indian or domestic company, a company registered in India as per the Indian Company Act is known as Indian company or a domestic company. Example: Tisco. Multinational corporation, a company which is registered in one country but carries out business in a number of other countries. We shall discuss in multinational corporation in the last section of the lesson. Holding and subsidiary company, The company controls neither company. The controlling company is under holding company, and the company so controlled is called subsidiary company. Distinguish between private and public. Public and the private sector. Public sector provides public goods not affected by recessions, government jobs to protect environment, help reduce inequality in society. In private sector, profit initiative to be efficient. Entrepreneurs creates jobs whereas needed, doesn't require a tax or fund. Thank you.